U.S. Insider, a premium edition of the Financial Sense Newshour. Today's host is Senior Editor Cris Sheridan.
Sam Burns is the Chief Strategist at Mill Street Research. And Sam, when we spoke with you in January to get your outlook for 2023, you had said that your indicators were in their most bullish zone based on the 8 indicators that go into it. And that was more over the 1 to 3 month outlook. Obviously, when we look back and see what's taken place this year, we did see a very big rally in the market. So let's talk about big picture. What are your indicators saying currently about the outlook?
Yeah, you're right. It's been a pretty good year so far for stocks, a lot better than I think most people were expecting coming into the year. And certainly when I was talking to clients or doing media, around late last year, early this year, it was a much more negative tone. Most people were expecting recession and, earnings to fall and, a lot of negativity out there. And I think the fact that things have turned out better than expected this year economically in terms of earnings has been what's driven the market higher. So there is, I think, a fundamental reason for it, both in terms of the kind of overall economy and also relative to what investors were expecting. And so when I look at my indicators now, they're actually still pretty bullish on balance, partly because the trend has certainly improved. The equity market trend is much more favorable now than, say, it was the beginning of the year. And also you've got inflation having come down, is a big help. And that's kind of reduced the pressure from the Fed. And essentially the Fed has already probably raised rates and tightened policy as much as it's likely going to. And so that has shifted the focus among investors from, is the Fed going to raise rates a lot more or is inflation going to stay really high, to will the economy hold up and avoid recession, and will corporate earnings be the driver now kind of going forward? And I think kind of that's been the rotation and kind of the focus of investor attention. And earnings so far have actually been better than expected as well, and have given reason for stocks to work their way higher. So my guess is that we can, probably not rise at the rate that we did the first half of the year, but certainly that there's still potential for more gains, and even potentially to try and get back into the old highs from the beginning of 21.
And if we look at the S&P 500, we got up just above 4,600 last month, late July, and then we corrected down to 43.35, and we've seen a little bit of a bounce from those lows. From your work, as you said, your indicators are still bullish. Inflation has come down, but I think one of the big concerns, especially since we've seen the correction since last month, small correction in the markets, of course, is that rates continue to push higher. We're looking at mortgage rates now breached well above the 7% level. In some areas we're seeing 30-year up as high as around 7.4, 7.5. So they continue to move higher. That's putting a bit of a dampener on some expectations. What do you make of the influence that these higher rates are having on the outlook?
Well, no, you're right. I think the correction we've had here in August is, in large part, partly, the market had just had a lot of big gains in June and July and was kind of due for a correction. It gotten overbought, and sentiment had probably gotten a little, bullish, at least in the short term. And so there was probably due for a correction. And then bond yields have backed up quite a bit in the last few weeks, as the economic data has been better than expected, and the Fed has kind of kept its higher for longer kind of messaging, suggesting that there won't be rate cuts anytime soon, and that the bond market had been previously kind of pricing in. So I think that's kind of made bond yields get closer to where the Fed is and push them higher, which of course then has implications for mortgage rates and things as you mentioned. So I think that's been a headwind for the last few weeks. I don't know that that's going to, necessarily be a major structural reason for the market to go back down a lot. I think it will, has provoked some consolidation and has raised worries that that's going to, slow things down, looking forward. I think the thing that's offsetting some of that is the fact that, like I say, Fed rates probably won't go much higher, and the fiscal policy is still fairly supportive. So you've got tight monetary policy, but supportive fiscal policy, and those two things are essentially balancing each other out in terms of the economy and corporate earnings, which is unusual. We haven't seen that in a long time historically. So I think that's what's going to help keep corporate earnings growing and keep this kind of a floor under the stock market to some degree, even with somewhat higher rates. I think the economy can handle higher rates, particularly real rates that we're seeing now, better than it could in past cycles because of fiscal policy.
Yeah, and that was something that you told us at the beginning of the year as well, that U.S. appears to be poised to withstand higher rates than in past cycles, and that you are believing that this lines up with a greater probability of a soft landing versus recession. Would you say that that is still the outlook? Investors should be expecting a growth deceleration versus a hard landing recession?
That's right. I'm more in this sort of soft landing, slow growth, which is where we kind of already are. I think, real growth is kind of running in the 1 to 1.5% range over the last few months. It might be picking up actually a little bit now. Third quarter looks like it might be a little better. But I think overall we're in a kind of a slow growth, but not negative growth. So not a recession, and don't really see one coming anytime soon, this year certainly, or even maybe early next year, just because I think there's enough momentum in the economy still from a combination of the lagged effects of all the fiscal policy and kind of adaptation to higher rates, and the fact that there's still a lot of that kind of lagged fiscal policy that's going to help support the economy for a while longer. So there could be supply shocks, but I think there's been a benefit to supply in both supply chains healing after COVID, but also new supply coming on from all the infrastructure spending and things that have been going on over the last 6 to 12 months, and will probably continue to go on for the next 6 to 12 months at least. So I don't know that we'll get any new fiscal programs just because Congress is now split, and that's probably going to be much harder to get anything through. But the ones that have been already passed are likely to have an effect, for a while longer, which I think will help the economy continue to grow even at a slower pace. And the fact that the rest of the world is not growing especially fast will mean that inflation probably will stay under control, and that there won't be kind of excessive demand globally, because Europe and China and places like that are not going to provoke too much growth. I think they're struggling a bit here lately. So the U.S. is definitely stronger than the rest of the world by most measures, and so I think we'll have relatively low inflation and some moderate growth without a recession, at least near term.
Now, speaking of China, because they have been in the news quite a bit lately with their property markets, China is facing some difficulties. What are some of the impacts that you expect from what we see happening in China right now?
Yeah, that's right. And I've actually been avoiding China for quite a while, in emerging markets in general, partly because China is such a big part of any emerging market index that you're going to look at. They've been struggling for a long time. When I look at the earnings estimate indicators that I track for globally for individual companies, but also for sectors, and for countries, the data for China have been actually weak for some time. Earnings trends in China are weaker than the global average. The average company in China is not doing very well, and that's consistent with the relatively weak economic data that we see there. And the fact that they've been struggling with debt issues and real estate issues, that's all part of that same kind of story that's been going on for a while. And I think they're going to struggle to kind of get out of that anytime soon. They're certainly trying to stimulate a little bit. They're trying to lower rates. They're trying to do some things to keep things afloat. But I think the underlying drivers are kind of headwinds now for China, and some of the other parts of Asia there, rather than tailwinds. And they don't have the scope to do the kind of fiscal policy and things like what we're doing here in the U.S. So I would avoid. I've been underweight emerging markets in China for a while. I would stay there. I don't see any real signs of a turn. There's a few Chinese companies that are doing well, or big global tech companies and things like that. But overall, they've been lagging for some time. So eventually the bad news will all get priced in, and there might be an opportunity. But I don't see that happening yet for China and emerging markets in general. So I would stay with developed markets, particularly the U.S. and Europe to some degree now.
Okay, so again, based on your primary risk model that you use for tracking the stock market, your indicators are still bullish and constructive on the U.S. stock market in particular. So you would be investing in the U.S. over emerging markets, over China. And the economic data has been beating expectations. If you look at some of the indicators that you track, even just in your research reports, it has been a more positive environment than what economists have expected. And it sounds like you expect that to continue, at least over the next 1 to 3 months based on your work. So it sounds like the main message here would be for investors to still look for outperformance in the U.S. relative to the rest of the world. If that's the case, any key areas where you see opportunities within the U.S.?
That's right. So yes, I think the U.S. has still got a lead over the rest of the world, and we've seen that certainly in the returns of the U.S. equity market versus other markets, and in the economic data and in the earnings data that I track. Earnings estimates are much stronger in the U.S. Right now than most other places Only maybe Japan is doing, almost as well. But yeah, so I think there's still opportunities probably in some of the cyclical areas and industrials, and some of the consumer areas that have been held up by both the infrastructure kind of spending as well as the strong labor market. There are probably still some areas there that are, going to hold up better than people expect. Certainly technology has been strong. It may have run ahead of itself a little bit here lately, but I think that's in the long term going to be still the place to be, just because I think a lot of the places like energy, materials, commodity related areas are relatively weak in my work, and still are. I think the longer term structural view for certainly fossil fuels in general, and oil in particular, are still somewhat negative. I think there's going to be a longer term shift away. There'll be a lot of movement back and forth in the shorter term, but I think that particularly with China being a source of demand for a lot of commodities globally, oil, steel, copper, all those kind of things are driven a lot by China in particular. And because they've been slowing and facing a lot of headwinds, that will keep downward pressure on a lot of those commodity related areas. So I would probably stay kind of underweight things like, kind of the more value oriented commodity type sectors, and overweight some of the consumer technology and industrial areas now that are getting the benefits of those fiscal policy supports. And so I think if you're looking for defensive areas to kind of balance it out, consumer staples, some of those areas again benefiting from pricing power and consumer spending. But I think you want to stay in kind of a little more of the growth side of things rather than the value side of things for now, and particularly if you think the economy is going to grow but not too fast. And that's kind of what the earnings estimate data is supporting as well.
Okay, so again, you are constructive on the outlook over the months ahead, and still believe that the U.S. can withstand these higher rates, that is not going to be perhaps, the straw that breaks the camel's back.
That's right. Yeah, still fairly constructive. I think the economy is in a better shape to withstand higher rates now than it was, say, in 05, 06, 07. And I think a lot of that is necessarily down to fiscal policy. The fiscal policy support won't last forever, but it will probably keep us going for a little while longer, another 6 to 12 months maybe. And I think the earnings are going to be the driver more so than rates as we go over the next 6 to 12 months.
All right. Well, Sam, always a pleasure to have you on our podcast to get an update on your outlook. As we close, what would be the best way for our listeners to gain access to your reports and research?
Sure. Well, you can certainly check out millstreetresearch.com, the website where you can see sample reports from the institutional work that I do. There's a blog there that describes some of the work that I do. And certainly you can follow me on Twitter or on LinkedIn, where I'll post commentary and sample reports and things periodically. It's a good way to get a feel for what I'm looking at and how my process works.
And I'll have links to all of that where this interview is located at Financial Sense. And again, Sam, it was a pleasure speaking with you. We look forward to having you on in the future.
Well, thanks very much. Appreciate you having me on.
The Financial Sense News Hour is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the News Hour each involve their own unique risk factors, which are not discussed on the show. Responses to listener inquiries are based on the personal opinions of the Financial Sense staff and do not take into account listener suitability, objectives, or risk tolerance. Financial Sense News Hour and its parent company shall not be liable for any financial losses that result from investing in any companies mentioned in Financial Sense or arising out of the use of any material on the News Hour. Be advised that you invest at your own risk.